Okay. Hey everyone, thanks for joining us. We have some great guests today. Whitney from IPX 1031 and Richard Miller of Miller and Associates, based here in Atlanta, Georgia. Great closing attorney. He helped facilitate this introduction for the webinar today. And I'm happy to have you guys all attend the webinar and get some more information on 1031s and get some value on some tax savings and potential deferral of taxes. I'm going to go ahead and turn it over to Whitney.
Thank you, Matthew. Thank you, Richard. I've been working with Richard for many years now and very much appreciate that relationship. I work as a qualified intermediary for a company called Investment Property Exchange Services, or IPX 1031. And by way of background, our company is owned by Fidelity National Financial that owns title companies. So you may be familiar with Fidelity National Title, Chicago Title, or Commonwealth Title. If you've bought property, get title insurance, we're all owned by that same parent company. And the reason I mention that is that when you do a 1031 exchange and you're deferring taxes when you sell an investment property, at closing, one of the key requirements is that you as the taxpayer, the exchanger, cannot touch the funds. And so when you're choosing an intermediary, you want to make sure that they're financially stable and are backed maybe by a larger publicly held company, as we are. I've been a qualified intermediary now for 23 years, and my main goal is to help you as an exchanger defer taxes. And in some cases, if you've never done a 1031, I've been known to talk people out of it if it doesn't make sense. Because when you do a 1031 exchange, you are deferring the taxes on the sale of investment property. And if you've never done an exchange and you have a low capital gain, so in some cases it makes sense to pay the taxes and not get on the treadmill, if you will, of doing a 1031. And what I mean by that is once you do a 1031 exchange, let's just say you buy a property for 100,000 and you sell it for 500,000, and you fully depreciated it down to zero. That's a significant gain of 500,000. You most likely would want to defer the taxes by doing a 1031. It's only a deferral. It is not a tax-free exchange. A lot of people refer to them as tax-free exchanges, and there's nothing free about it. You're just deferring the taxes until you either sell outright and don't do a 1031, or you keep exchanging until you die. You swap till you drop. Maybe you've heard of that before, but let me repeat this. When you do a 1031, you're deferring the taxable event. So if you keep exchanging, so you sell that property for 500,000 and buy a new property for 500,000, you'll defer the gain, as I mentioned. And if you hold that property forever and die, then all the deferred taxes go away upon death. And if your basis was zero, in my illustration, then whoever inherits the property, if Richard was my heir, he would receive that property as a full stepped up basis, and all the deferred taxes go away upon death. And that's one of the reasons people like to exchange, is it's a great wealth building tool, but it's a great wealth building tool for your next generation. But while you're living, people enjoy appreciation of property, and they like to take depreciation. So those two variables coupled together create wealth. But again, if you're going to do a 1031 exchange, it's very important to talk to your tax advisor or legal advisor, and you should have a gain in the property. Now, if your property has come from a 1031, you need to keep exchanging, or you owe taxes back to the original basis if you sell outright. So a lot of people want to know what they're deferring in taxes. I'm not a CPA, but often I feel like I play one. If you've held the property for over a year and a day, that's when long-term capital gains will kick in. In other words, if you're selling a property that you've held for 1 year and 1 day, and you sell outright, you'll pay long-term capital gains to the IRS at a rate of either 15 or 20%, and that's dictated by your ordinary income tax bracket. If you're an individual and you have a gain of over 200,000, you will pay an additional 3.8% tax. It's called the net investment income tax or the healthcare tax because it came about in a healthcare trailer bill in 2017. A lot of people are not familiar with that tax. If you've been depreciating your investment property and you sell outright, you owe what's called recapture on depreciation, and that's 25% on all the depreciation you've taken over the years. And then you'll pay a state tax depending on where the property's physically located. So I'm here in Georgia, as many of I think you are as well. If you sell a property that you own in a different state, you'll pay the state tax. All told, if you owe these four taxes, you typically owe about 30% in taxes. But if you do a 1031 exchange, you can defer all of these taxes. Again, if you do a 1031 exchange, and I'll go over the requirements on how you defer all these taxes, you typically are going to get hit with 30%. Now, I'm originally from California, and you might have clients that are coming from different states. And it's good to find out if they're, buying a primary residence here. If they're selling investment property in another state, they can relocate their assets to Georgia. And I am in California, the long-term capital gains rate was 13.3%. So there was a lot of reasons why I did sell an investment property one time. And unfortunately, I didn't do a 1031, but a lot of my clients do. And that 13.3 really hurt. And so when you sell a property from a higher tax state, you're looking upwards of 30 and even sometimes 40% in taxes. Now, there are 8 states currently that have a 0 state tax. And the reason why I mention that is sometimes people will buy properties in those states to use them as a way to mitigate taxes when they start selling properties outright and don't do a 1031 exchange. So if you sell here in Georgia and buy a property in Texas and someday sell it, you won't pay a state tax. Just food for thought. Okay. So what is like-kind property? It's the only type of property that you can actually exchange in a 1031. So if you've been holding rental property and you've held it for what we call productive use in a business, trade, or investment, so a single family rental, you can exchange it for commercial retail, commercial apartments, single family rentals, raw land, industrial property, commercial property. You can even sell your property that you own 100% of and go in on it with another investor. So if Matt and I each were selling our own respective investment properties, and I was selling one for $300,000 and he was selling one for $700,000, and we wanted to buy one together that cost $1 million, we could buy it as tenants in common. And one of the rules about doing 1031 exchange is the taxpayer that sells needs to be the same taxpayer that takes title to the replacement property. So as long as you're selling, and if we both sold in our individual names, we could buy a replacement property together, as long as we each spent all of our proceeds. And if he brought in $700,000 and I brought in $300,000, I would own an undivided 30%, and he would own an undivided 70%. You can exchange anywhere in the United States, including the U.S. Virgin Islands. You cannot exchange property into a foreign country. You can be a foreigner and do exchanges in the U.S. We like to flush that out early. So if you are a foreigner, but you have either a social security number, a green card, you can do a 1031 in the U.S. However, if you're a foreigner and don't have a social security number, you have to use additional documentation called some FRPTA documents. You can call me if you're someone that is thinking about doing an exchange and you're a foreigner. So here's an illustration of what like-kind property is. I like to see it spelled out sometimes. So if you want to take your residential property and exchange it for commercial property, that works. It's all about the intent. You can take your commercial property and exchange it for an industrial property, another type of commercial property, single family for multifamily. So that's residential for commercial, that works. And here's a question I get every single day. I have a piece of land and it doesn't produce any income. Am I still capable or able to do a 1031 exchange? And the answer is yes. As long as your intent has been holding for investment purposes, you're able to do a 1031. And I encourage you to call me if you have questions. That's what we do. We talk to potential exchangers all day long. So you could even take a swamp land and exchange it for a bank building. So it's really about what you're holding the property for that would validate your exchange. If you're buying properties and flipping them and your intent is for resale, you do not qualify. I know that's a very popular trend. People buy a house and then they quickly turn it with some improvements and then they get it back on the market for resale. A flip doesn't qualify because your intent was for resale and not holding for investment. So why do people 1031 exchange? They'll do it for diversification, and we'll talk about all of these: consolidation, moving markets, and estate planning. Those are the most popular reasons that I see. And what I mean by diversification is that maybe they own all of their property as land, and maybe they're land rich but cash poor, and they want to take that land and exchange it into maybe a commercial property or a residential income producing property, or what we call Delaware statutory trust. That might be a new concept for you, but it's commercial grade property. They're all over the US and you own undivided interest. It's a very popular vehicle when you're going into your retirement years. It's a hands-off, passive way of owning real estate, and it pays you a distribution every month. It's also a really good product in this marketplace. Inventory is still really low. And if you're having a hard time finding replacement property because there are timing requirements, which I haven't talked about yet, a DST, or they're pretty plentiful and they're pretty easy to identify. So again, you might want to sell one type of property and diversify not only by property type, but by geography. Now, consolidation, I have a lot of clients that get into their upper years and they've collected a lot of properties over time and it gets to be too cumbersome. So I'll see people take lots of properties and sell them and buy maybe one property, that maybe one big commercial property. Now, keep in mind when you're doing a 1031 exchange, one of the first questions I would ask is, did the property come from a 1031? If it did, you need to keep exchanging. Also, I want to know who the taxpayer is. Are you an individual that's selling a property, a trust, an LLC, a husband and wife? Who owns the real estate? Because that taxpayer, you'll see 4 properties on the left-hand side of the screen. The 4 properties could all be owned by different taxpayers. You might own in your LLC, your trust, your husband and wife, and an individual. And you're all lined up to buy the one replacement property. If you sell in 4 different taxpayers, we have to set up 4 different exchanges, and you have to take title to the replacement property in those 4 different taxpayers. And you're probably thinking, well, I'll just do a quitclaim deed right before the exchange and put them all in my trust or all in my LLC. You can't do that unless you do it a year and a day before you sell those properties. And the reason being is you have to demonstrate that you've held for productive use. And the question I get is, how long is productive use? Is it 2 years? Is it a year and a day? You have to demonstrate that it's been held for investment. So typically a year and 1 day satisfies that requirement, but you always want to check with your own CPA, the person that's signing your tax returns. People want to exchange because they're moving markets. During COVID, I saw a mass exodus from California and New York. Those states that were densely populated, people wanted to get away from other people, and they moved to the Carolinas and Georgia. So you can, again, move anywhere in the U.S., and I should say move your investment property anywhere in the U.S. and do a 1031 exchange. Now, estate planning is a very popular reason why people do 1031s. So you might be the matriarch or patriarch of the family and own a very large investment property, and you have multiple heirs. And in some cases, I've talked to folks that they're like, well, my family doesn't get along, and upon my death, there's going to be a lot of squabbling on who gets what. It's good reason to set up a will or even a trust that outlines who the beneficiaries are. But in the 1031, if you 1031 exchange, and in your will, you leave a replacement property to each of the heirs, That works really well. Each person gets their property earmarked at death, and a will is a great way to make sure that the intended recipient receives their property. And again, with the 1031 exchange, all the deferred taxes go away upon death, and the basis gets stepped up to fair market value. And so each of the heirs can do what they want with the property. You could, if these were all residential properties, one heir could move in, one could turn around and sell it immediately and put all the cash in their pocket tax-free, and the heirs can make it a rental. So the basic 1031 rules are this. In order to defer all the taxes, it's very simple. Rule number one, if you follow this rule, you will defer all your taxes every time. You just need to purchase equal or greater than the sales price or the value of the property you're selling. So if you're selling a property for $1 million, I like to use that number, then you just need to buy a new property equal or greater than $1 million. That simple. So if you own it free and clear, you just need to spend all of the net proceeds into a new property. But a lot of the clients I work with have debt associated with the property that they're selling. So what happens if you have a mortgage on a property that you're selling? Well, that mortgage is going to get paid off at closing. And two, you need to reinvest all of the proceeds from the sale of the relinquished property, as we call it, into the replacement property. And three, you need to replace that debt that you had on the relinquished property, and you need to acquire new debt on the replacement property and receive nothing in your hand, no cash at closing, for a fully tax-deferred exchange. So again, if you buy equal or greater in value, you will defer all your taxes. In fact, this is a nice illustration of what happens at closing. The taxpayer just needs to meet two requirements. They need to reinvest all of their net proceeds and acquire a property with same or greater debt. So if I'm selling for $1 million, like I said, the mortgage that's getting paid off is $300,000. I'll have closing costs that I can use 1031 proceeds to pay for, and then debt's going to get paid off. So at closing, after all that occurs, the closing attorney, like Richard, will send us the net proceeds after closing costs and debt is paid off. So here's what happens with, let's just say I'm the client. I sold, the proceeds went to the intermediary. I found a new property that was equal or greater. It was 1.3 million. I found the property, and I went and got pre-qualified for a new loan that was greater in value, and I spent all of my proceeds that I had with the intermediary. That's an illustration of a fully tax-deferred exchange. There was no boot, as we call it. So again, equal or greater in sales price, equal or greater in debt, and equal or spend all your proceeds. So what happens if you buy a lesser valued property? So some people, their CPA says, it's fine to buy a lesser valued property because you have passive losses. So when I see somebody selling a property for $1 million and they go out and buy an $800,000 property, I always call them because I don't know typically the full story. But if you sell for $1 million and you bought for $800,000, you'd be taxed on the difference. The difference is $200,000. However, you can offset that difference with closing costs. So what we call for closing costs are $60,000. So the difference of $200,000 offset by closing cost is $140,000. Specifically, this person bought a lesser valued property and they got a new mortgage of $260,000, and then we call it mortgage relief of $40,000. And the proceeds were with the intermediary. They only spent $540,000. So there's a difference of $100,000. So the total boot is $140,000. Again, it's not $200,000 because they can offset with closing costs. Now, so when I call up the client, I'll say, did you know you could buy 2 replacement properties? A lot of people don't know you can sell 1 and buy 2. Some clients want to pay taxes on the difference. Or sometimes the answer is their CPA told them they can buy a lesser valued property because they have passive losses to offset that difference. So that's an example of an exchange that has boot involved, and some people like the boot. And it's perfectly, it's in the eyes of the beholder how much tax you want to defer. So when you do a 1031 exchange, you have to have a qualified intermediary. Now, Richard is the closing attorney, and so he can't set up the 1031 exchange because it would be a conflict of interest. He's an agent to the transaction. And someone like Matthew, same thing. He can't set up the exchange either because he literally is a broker or an agent. And anyone that's been involved with you, like your lender can't set up the 1031, your CPA would be a disqualified party. So you have to go to a neutral party, a qualified intermediary. Again, check out your intermediary before you engage them in services. Not all intermediaries are the same. Now, when you do a 1031, when you're selling first and buying second, it's called a forward exchange. About 95% of our clients set up exchanges in that manner. It's a lot easier. Because the deeding goes directly from you, the seller, to the buyer. And IPX does not get into chain of title. And what happens is you're going to sign what's called an exchange agreement. That's the legal document that the qualified intermediary prepares. And what we do is we get a copy of the contract for the property you're selling, and then we get a copy of the deed or the title commitment that shows how you're invested. How do you own title? And typically we'll get the title commitment, has a legal description of the property, and we get a copy of your driver's license. And then we prepare the exchange docs that need to be signed on or before your closing date. So if you're closing on June 1st, all of that information needs to be gathered and collected, and you sign your exchange documents on or before that date. The closing date of settlement, triggers your time clock. So the documents need to be set up before then. And from that date, June 1st, you have 180 days to buy replacement property. And in the first 45 days, you have to identify on an identification form that we, the intermediary, give to you. By the way, exchange agreement and identification form, those are commonplace terms amongst qualified intermediaries. So when you throw out those terms, they'll know what you're talking about. So an identification form has to be received by midnight on the 45th day. And the nice thing is, regardless of when that date falls, if it's a holiday or a weekend, you can email us that form, and that qualifies as long as you get it to us by midnight. The 180th day, if you're due to close on a weekend or holiday, you need to go in the business day before. There are no extensions to these dates unless there's a presidentially declared disaster. And so here we go. The 45th day, you have to identify in writing to the intermediary, and the replacement property has to be purchased by the 180th day. So if you're buying a property that's being built and you don't get the certificate of occupancy and it closes on day 181, you have a failed exchange. Recently, we've had a lot of catastrophic disasters, unfortunately, and like Hurricane Helene and Milton, there were presidentially declared disasters, and extensions were granted. In fact, Helene had extensions to May 1st, and we were just in North Carolina. They extended those again until September, not in Georgia. But if you're not sure of your timing for the 45th and 180th day, we have all that in our computers and readily available. And if you're due an extension. So if you're not sure, we always suggest giving your intermediary a call. So those are the steadfast rules, the 45 days and the 180 days. You don't have to use all that time. And in fact, when you get really good at exchanging, you sell and you'll buy very quickly on the heels of the property you sold. Now, what it means to identify a replacement property means you're going to write down the physical address of that property on a form. And there are 3 rules of identification. You're only in 1 rule at a time, and most people are in the 3 property rule. So if you sold a property for $200,000, you might ID a property at $200,000, maybe something at $300,000. You could even buy something or identify something at $500,000. Remember, you can ID only 3 properties in this rule, but they can be any value. You could even ID properties that add up to 200,000. So maybe two properties at 100,000 and one at 200,000. Again, only three properties. The 200% rule allows you to identify more than three. However, the aggregate value of those properties that you ID over three can only add up to 200% of your sales price. So, for example, if you sold a property for $1 million and you put four properties on your form, the four properties, the sum or the value, the aggregate value cannot exceed 2 million because you take 2 times your sales price if you physically put more than three properties on your ID sheet. And so if you ID'd four and they were all 500,000, you're exactly at 200% or 2 million. You don't have to buy that much, but it gives you a little bit bigger list to choose from if you rather than just putting three properties on your ID sheet. Now, if you over ID, let's say you put those same four properties on your form, but they had higher values, like 600,000, the aggregate value would be 2.4, and you would actually have to purchase 95% of what you've ID'd. But at our company, when we get an ID form, we actually call up the client and walk through what they identified and make sure they understand what rule they're in, and make sure they understand what they're buying. And because I've had people where they've identified 30 properties and they add up to like 30 million, and I'm like, well, you have to purchase 95% of 30 million, and people are like, well, I can't afford that. So we keep you on track from A to Z during your 1031 exchange. Anytime we think something's amiss, we call you. Now, earlier I said you could only buy investment property. So if you sell an investment property, you can only buy an investment property. And living where we do here in Georgia, we have a lot of people that buy mountain properties up in Blue Ridge, and we also have people that like to buy things at the beach. And that's perfectly acceptable to buy a property in those fun locations. But keep in mind, if you buy a property in the mountains or the beach, you are limited to your personal use under Revenue Procedure 2008-16. You get 14 calendar days a year or 10% of the total time you rent it. And I would not go over that, because you never know who's watching, and you certainly hate to be audited and have to prove your usage. Some people want to know if they can convert their Airbnb or their beach property or their rental property into a primary residence, and the answer is yes. However, there's certain requirements you have to adhere to. You have to own both the relinquished and the replacement property each 2 years, and you can't use that property again more than 10% of the total time it's rented or 14 calendar days. But if you adhere to those requirements, you can move into the replacement property after you've met those minimum requirements. So again, you can sell your rental property to 1031 into your dream home. You buy the rental property, must be held for productive use, and then rent it out for 2 years, the replacement property, before you move into it, and then you can live there as your primary residence. The question I often get is, what happens if I want to sell that property? I converted it to a primary residence, and it came from a 1031 exchange. There's some stipulations if you want to sell it as a primary. And the first being is you have to be on the deed for 5 full years if you converted a property from investment to primary, and you want to sell it as a primary. So after year 5, let's just say you rented it for 2 and you lived there for 3, you're at year 5, and you could sell that property conceivably as a primary residence. However, you do not, I should go back to this screen, do not get your full primary residence exclusion. You get a proration on your primary residence exclusion. So you would, in the numerator, take the total years of living in that house as a primary residence over total years of ownership. So first 2 year rental property, you lived in it 3, so 3 over 5 years of total ownership. And if you're married, you would take 3/5 times 500,000 when you sold that primary residence. However, at that point, if you sell that house, you owe now what's called recapture on depreciation. So if you took any depreciation on that property or any prior investment properties related to this property, you owe all the recapture back. So that could be a hefty tax. And so when thinking about converting from investment to primary, it's always advisable to get your CPA involved. And you can certainly call me for advice on how to structure this. One more little tidbit, some people will move out of these houses, out of their primary residence and rent their property for another couple of years. And they come to a unique status where they can call this house either their primary or their investment. So if you can look back at a property and say, did I live there 2 out of 5 years? It's technically your primary residence. And if the last use was rented for 2 years, you could exchange it. So in fact, you can double dip into 2 tax codes. But the window of opportunity to do that shrinks from the day you physically walked out of there as your primary residence. You have 3 years from the day that you walked out of there as a primary to sell it as a primary. So just a unique opportunity to think about. And again, you can call me about how that gets structured. And we have a lot of clients that do that. And in fact, what they'll do is they'll take their primary residence exclusion, and then they'll take the 1031 portion and put it into something like a Delaware statutory trust that has a nice income stream in their retirement years. And that's the way to get around that depreciation recapture. So when you do a 1031, you have to use a qualified intermediary, like I said earlier, and we act as kind of the principal of the transaction in terms of setting up the 1031. We hold the proceeds. Again, if the proceeds go to you at closing, you've just failed your exchange. So if you're going to do a 1031, let the closing attorney know as soon as possible, because we are communicating very closely with the closing attorney. And again, we get a copy of the contract and we get a deed that shows how you're deeding over to the buyer. And by the way you sell, again, is the way that you take title to the replacement property. We prepare that legal documentation called the exchange agreement. It must be signed before you close. And then we provide the service. We are happy to structure your deals, particularly when they get complicated, like they can be when you're selling in an LLC with other folks that might not want to do a 1031 exchange. And the key to it is forethought, thinking ahead. If you own a beach property with 10 other people in an LLC and you want to go your separate directions, you should likely drop out of the LLC a year and a day before so you could hold as tenants in common and reestablish your holding period. So just keep that in mind. Also, when you do a 1031 exchange, we start off setting up our clients by having them fill out an intake form. And it's really important if you're going to do a 1031 exchange is for you, the taxpayer, the exchanger, to fill out that form, because you're going to provide us your name, your home address, cell number, and email, and let us know the entity you're selling in. And let us know who your closing attorney is. If anything changes, like your cell number or your email, we stop the transaction. And as we think it's fraud. So that's just one of our security protocols. In order to do a 1031, you have to have a US phone number that we can reach you on. And again, your email can't change. And so we've stopped fraudsters from penetrating exchanges, because if we think anything looks funny, we stop everything. On that same note, when the proceeds come to us at IPX, if you need funds for a replacement property earnest money deposit, we're happy to do that. We just need a copy of the contract for the replacement property, and we need to know who the closing attorney is in 48 hours notice, because you're going to sign an authorization to disperse funds. Anytime there's any money movement, you will always sign an authorization to disperse. We always call the closing attorney and verbally go over wire instructions with them. And so that's just one of our security protocols. And by the way, we our bonding, and here it is. We're going to talk about it right now. We carry a fidelity bond that's $100 million. Our errors and emissions is 30 million, and our guarantee goes up to 50 million. For larger transactions, if we need gap insurance, we get it from our parent company, Fidelity National Financial, which is publicly traded. And on our website, we have copies of our insurance, so it's pretty transparent. At closing of an exchange, your funds are I should say, deposited into a segregated bank account. So we never commingle funds with any other exchanger's money, which is a good thing to find out. If you use different intermediary, find out what they're doing with your funds. Are they reinvesting those funds? We would put them into an exchange account separate from everybody else's. We don't commingle and we don't invest the funds. They have to be in an account that we can get quick access to for a quick closing, or just if we need an earnest money deposit. And like I mentioned earlier, if there's a disbursement of funds, it does require written authorization. And the banks that we do use right now are Citibank, US Bank, and Capital One. And those are chosen by design. They have a very high IDC rating. The perfect IDC rating by a bank is 300, and we only bank with banks that have ratings of over 250 or above. And an IDC rating is the rating of the deposits. And so the higher the rating, the more secure the deposits are. And then real quick, I'm Whitney Brennan. I'm here in Atlanta, Georgia. And I'm going to leave it open to questions, because I always find that that's the most beneficial part of a presentation, is to find out what you're thinking and what questions you have.
Yeah, thank you. That was excellent. There is a Q&A section, so if anybody does have any questions, certainly feel free to drop them there. Very comprehensive presentation. Appreciate that. Took some notes here while you're going through that. So, one of the great things you pointed out was that you can sell in one state and buy in another. We work with a lot of investor clients, so we have definitely seen that last few years where they're selling in California or another state, like you mentioned, to buy in Georgia. Or they can buy multiple properties if they sell one property, or vice versa. So we do see a lot of clients, use the 1031 as a tool to either diversify or move to a different state or kind of reposition. So definitely appreciate all that information. Another thing that I've seen some clients do that I didn't really see mentioned, but can be a great tool as well, is they'll 1031 into another property and then do a refinance after. So that refinance is not taxable because you're actually borrowing money from the property
Right.
that you own. So that could be a great way to defer the taxes in that property that you 1031, but then use a refinance on top of that to access that capital later.
Yeah, that's a great point you bring up. If you're going to do a refinance on the property you purchase, be sure not to start it before the closing of that property. Make sure it's a separate and distinct transaction, and you come back after the fact. But yeah, as you suggested, it's a great way to access cash, and you're only paying interest rather than taxes. And on that similar note, if you do a refinance on what you're selling, you really need to wait a year before you do a 1031, because if you got audited, the IRS could come back and say, hey, you pulled out cash to your benefit. So be careful about refinancing. Definitely do it on the backside, but then wait a year before you sell a property in a 1031. Really good point.
Yep. And definitely, want to make sure you're holding that property for a year, that you're the relinquished property that you're selling, because that's, a piece of the 1031. And then another tool, I know you mentioned the forward 1031. I have seen on occasion some use the reverse 1031. I know you mentioned about 95% of people do the traditional forward 1031, but I just kind of want to hit on the reverse 1031 real quick, because I know that kind of help with some of the timelines, because when the market's kind of crazy, sometimes people feel like they're a little rushed to identify those three properties and close in 180 days. So they can use a reverse 1031 in those cases to kind of, back into it, so to speak.
Right. And so let me just tell you, a forward exchange, our fee is $1,250 for one sale and one purchase. The reverse, a lot of people, like you said, feel comfort in finding that property and closing on the replacement. So you can't own what you're buying and selling at the same time. So the workaround is called a reverse exchange, and the intermediary, IPX, takes title to your replacement property, and we lease it back to you at a $0 lease. Because IPX takes title to the property, the expense is a lot greater just because there's inherent risk that while we're on title. So the fees start at about $6,000 for a residential reverse. And keep this in mind, there are only about two lenders that I know in the country that will lend to that structure. The residential lenders don't like the structure of us being the on loan documents and the sole member of the LLC, and you, the exchanger, has to guarantee that loan. Commercial transactions are fine, or you have to have cash and lend to the LLC. And commercial transactions are a little more, I would say, well, there's a lot more work involved. You need a phase one environmental, and the fees start at $7,000, and they go up commensurate with the replacement property purchase price.
Perfect. And we do have a question in the Q&A section here. So the question is, once the 1031 is activated, when does an investor or how does an investor receive the funds in a legal way as cash flow or something like that? So Whitney, I'll let you answer, but I think if I understand the question correctly, it is trying to differentiate the actual funds and any kind of cash flow. So the cash flow would be separate, but I'll let you answer the question fully there.
Is that for the reverse or for
I think they're just asking for a 1031 in general. I think there may be confusion between the cash flow and the actual sale proceeds. So 1031 would protect against the capital gains. It wouldn't affect the cash flow. That would still be, taxed as rental income.
Right. So when you have your rental property and each month you're collecting income, at the end of the year, you're going to report that your CPA, you're going to report that as ordinary income. So when you sell that property, we're helping you defer capital gains. And we're assuming you've held the property over a year and a day. And so what you're deferring is the gain in the property. So it has nothing to do with the rental income that you enjoy every month. That's going to be reported on your tax return, and you will pay ordinary income taxes on it. There's no way around that, paying the rent on the rental income. But when you sell your property, and let's just say you bought it for $100,000 and you sell it for $500,000, you have a $400,000 gain if you didn't take depreciation. And rather than being hit with 30% on that $400,000, the 1031 allows you to defer your taxes, all of them, as long as you buy something equal or greater than $500,000. So don't be confused with paying taxes on your income received from the property as opposed to the gain when you sell it.
Yep. Yeah, and another thing I would add to that, because it's not only deferring the capital gains, but it's also deferring the depreciation recapture. So, it doesn't happen that often because most of the time property is going to appreciate. But I had a client a while ago that did a 1031, not that he had a huge gain, but he had owned the property for a very long time. And so there was a lot of depreciation that he took because he had this property for 10 plus years. And so he actually bought a pretty similar price property. I mean, it was a little bit more, but pretty similar, all things considered. But he was able to defer that depreciation recapture and basically, move that basis over to the next property.
Right, you're absolutely correct. So a lot of people aren't sometimes aware of that, the depreciation recapture, and that can really, sideswipe somebody, and they're like, "What is depreciation recapture?" And it plays into a huge 25% on all the depreciation you took. And so again, there's 4 potential taxes you can defer when you do a 1031. There's the state tax where the property is located. There's the recapture Matt just mentioned. There's the net investment income tax, which not everybody has to pay. And then there's the state tax. Generally speaking, if all 4 taxes are applicable, it's about 30% in taxes you would pay when you sell the property.
Yeah, yeah, and it could easily be more than 30% depending on income level and
Yep.
things like that, because just the capital gains alone could be 15 or 20%.
Yeah.
So it just depends
Yep.
on how much depreciation you have. But it's an excellent question to talk to, your CPA or tax preparer kind of to get an estimate on what the taxes would be. Because you are right, a lot of people do overlook the depreciation recapture and net investment income tax and some of these other items that just kind of pile on top. So the 1031 is a great tool if you are in that situation.
Yeah. And I was just thinking of something as it came. It's a really popular question. When you do an exchange, you can sell to anyone, including related parties. But when you buy a replacement property, you can't buy something you already own. I get that question probably once a day. You cannot pay down mortgages for other investment properties. You have to buy a replacement property you do not already own. And that includes also buying from related parties. So if I'm selling a property to my daughter, I can't turn around and buy from my husband because he's related, and that just doesn't work. So we ask you who you're selling to and who you're buying from as well. So we're, not interrogating you to be nosy. We're doing it so that you stay within what we call the safe harbors of the 1031 exchange.
Mhm. Yeah, and you also briefly hit on DSTs, which is great. I don't always recommend DSTs just because their returns can't be, they're not always great, but I think it's a great option to kind of list on your three options as a possibility if you can't find a replacement property. I know we had a client here recently, probably about a year ago, that we managed a number of investment properties for them, and they just kind of wanted to wind things down. They ended up selling, I think, two of the five that they had ended up putting those in a DST just because it's completely hands off. They didn't have to worry about it, and it was kind of an easy option
Mhm.
for them as they were getting to retirement age.
Yeah, exactly. It's just an option.
Yeah. Well, Whitney, I really appreciate all your time. Let me see if we have any other questions here. I think that covers all the questions in the Q&A, but I really do appreciate your time. And certainly, if anybody has any questions, certainly feel free to reach out to Whitney, reach out to Richard Miller or myself, and be happy to help you any way we can. So Whitney's information was there. You can email me, Matt at onesourcere.com, or give me a call. The number is going to be 678-668-6526. And we'd be happy to help any way we can.
Okay. And we'll send you a copy of the slides so you can review them at your leisure.
Yeah, that'd be great. And certainly feel free to let us know if you have any questions. We appreciate everyone's time tonight.
Thank you very much.
All right. Hope everyone has a great night.